Larry, thank you so much for joining us at the last moment here. Give us your take on the combination. It's a combination now of Jay Powell and Lael Brainard.
I think it's a good choice. This is a good team at the Fed, David. I'm glad that the president made this choice. This is the team that guided us through the response to the financial crisis. Jay was at the helm, but Lael played a key role in the design of the facilities that enabled us to maintain much smoother financial markets and have a much more rapid recovery than people expected, particularly in the traumatic early financial moments of that crisis. I think that this is a moment when continuity is a very good thing to have at the central bank, and that's what we're going to have with these selections. I do think, as I've said many times, that the Fed, now that we're going to have a leadership team in place that's got a long runway, does need to do some very serious thinking about the inflation and overheating risk and the balance of risks. And I believe that we're going to need substantial further evolution in our basic monetary policies. But I think we've got two first-rate people in Powell and Brainard, and so I'm hopeful that that's what will be coming.
So Larry, exactly right. You and I have talked quite a few times now about your concerns about inflation, which thus far have been borne out, I think, to nobody's delight, including your own. What is the possibility of both staying the course and changing the course at the same time? Continuity on the one hand, but the evolution that you say is necessary.
Look, I think it's the essence of central banking and more generally the essence of policy, not to be completely predictable, but to be completely responsive. That is, you don't know what's going to happen in the future, so you don't know for sure what you're going to do, but you know you'll respond whatever comes. And what's come has been a superheated up economy, as manifest by the labor shortages, as manifest in the quit rate, as manifest in cost of living allowances coming back in wage increases, wage pacts, as manifest in the inflation figures. And so that's what you've got to respond to. And I'm hopeful that Powell and Brainard, working cooperatively, will lead the Fed in making just that kind of adjustment.
So Larry, I'm curious about, I'll call it a soft landing. From the very beginning, you've said one of the concerns you had is that inflation would get out of control. The Fed would have to really act precipitately, and it would lead us into a recession. Where are we right now? Is there a way out of this now to really bring inflation back under control by the Fed, not fiscal policy, but by the Fed, that doesn't really lead to significant contraction of the economy?
We've got a lot of risks. We've, in my view, let it go too long. And the evidence is, it's a rule attributed to Claudia Sahm that if the unemployment rate goes up 0.5% from its previous minimum, then we always have a recession. And we've got unemployment coming down and very tight labor markets, and we're going to have to slow that up. And doing that in a gentle way that avoids a recession isn't going to be easy. But I know that both Jay Powell and Lael Brainard will be super focused on doing that in as accurate and precise a way as possible. They're both very serious analysts of the economy, and so I'm hopeful about what the play out will be.
Well, as you say, there are risks no matter what happens in many important policymaking positions. That's true. But give us your best guess right now in terms of tapering. We had Paul Krugman, who you've said he's a former classmate of yours, a friend, on earlier, and he said he was in favor of tapering, actually, and I think maybe even faster than what the Fed is doing at the moment. What he really has problems with is raising the rates. How fast would you taper if you were Fed chair now?
I'd be looking to end the mortgage-backed security purchases, which I think serve no purpose other than inflating the housing market, almost immediately. I'd be looking to accomplish the whole taper within about 3 months. And I'd be looking to the very real possibility, if things continue as they are, of raising rates not too long after the turn of the year. I think the risk analysis is very clear now. If we let inflation rise and become entrenched, we're going to be looking at least a marginal version of what Paul Volcker had to do in the late 70s and early 80s that has immense cost. If, on the other hand, we raise rates prematurely, well, Janet Yellen did that during her time at the Fed, and then the Fed reversed course and lowered them back all before COVID with no substantial damage to the economy. So I think the risk analysis points to not getting behind the curve. Another way to say it is, when you're steering a very big ship that turns only sluggishly, when you see an obstacle, you kind of got to start turning long before you get near that obstacle. And that's what monetary policy is. It's a very, very long tiller because of the lags on the economy. And so you got to start making adjustments promptly. And so I think the Fed needs to recognize that. I'm guardedly optimistic, looking at the trends in their rhetoric, that they may get on the program and be responsive, because the data points do keep coming in ways that are concerning. And I think now, with all this overhang of political uncertainty past us, if Congress moves quickly, as I very much hope it will, to strongly confirm the Powell-Brainard team, I think that it will put us in a position to carry on as best as is possible monetary policies.
Larry, to what extent will the Fed be assisted in a battle against inflation by what's happening on the fiscal side? And by that, I mean this. A lot of the way we got into this, you've told us from the very beginning, you told me at the very beginning of the proposals from President Biden that the fiscal stimulus was just too big. Well, it's coming off now. It's going to go down. Next year is going to be less than it was this year, goodness knows, and the year after that, even less. Will that help correct the problem even without Fed intervention?
It will help, but I think, David, that we've still got a lot of banked stimulus from the support that was provided to the government, provided by the government to households last year. And there's still a very big overhang of savings as that gets spent, as people respond to the fact that they've run down their credit and now they're in a position to run it back up. I think you're going to see strong stimulus-generated spending for quite some time to come. So I wouldn't exaggerate that. And that's why I think we need to be careful with respect to any new fiscal legislation to pay for it, and hopefully to pay for it in a relatively contemporaneous way. That's why that's one of the reasons I'm very unenthusiastic about the state and local deduction provisions that were contained in the House bill. Most fundamentally, I don't really see why people like me need a net tax cut. Very much the opposite seems to me appropriate for broad reasons in the country. But I also think that retroactive state and local deduction is something that's going to insert a lot of money into the economy at a moment when there's no particular reason to do that.
Larry, you, of course, are a macroeconomist, without a doubt. And so when you and I talk about the Fed, it's mainly about one half of the responsibility of the Fed. But there's another part of it, and that's the regulatory side. Something we did not hear today was a nominee for that other vice chair position in charge of regulation of the banks, which I know you take very, very seriously. Elizabeth Warren has really been pushing this hard. She's very disturbed by this nomination. What do you think about not nominating that person now? What's going on?
I suspect the administration just takes time to put its full slate together. The processes of vetting people these days are extremely elaborate. And I've got confidence that President Biden, Janet Yellen, Brian Deese, Kathy Russell, who heads White House personnel, will make a good choice. Look, what I hope for is somebody who is deeply committed to rigorous financial regulation in the way that I think is necessary, in the way that Dan Tarullo was during his time at the Federal Reserve. At the same time, I have to say that I don't think we should be appointing someone who believes that banks should be replaced with a public utility, or who believes that banks should be removed entirely from the business of risk taking, as some of the statements from the administration's comptroller nominee has suggested. So I don't think, I think there's room for substantial change from the policies that were pursued by outgoing regulatory vice chair Randy Quarles. And frankly, I think Jay Powell could use pressure from the pro-regulatory side from within the Board of Governors. But I think it has to be balanced, and that sometimes Senator Warren can overstep in her enthusiasm for attacking financial institution success. You know, I think, David, can I say, if I can just say one more thing, I think in a way, the most significant of the statements your Washington correspondent referred to was the statement that Senator Sherrod Brown had endorsed this pick. Senator Brown from Ohio is an extremely strong supporter of labor interests, a very strong progressive in favor of working people. He's been very concerned about financialization, yet I think he's come to the right conclusion that this is a set of nominations that should be supported and should be complemented by a sensible, tough regulator. That's what I hope and expect we'll get.
One more, and believe it or not, it's on oil, Larry, because reports are, including Bloomberg is reporting, that the president is about to have a release from the Strategic Petroleum Reserve, perhaps in conjunction with some other countries. At the same time, OPEC Plus is saying, you do that, then we'll just supply more oil ourselves, and we'll make up the difference, or we'll cut back on production, rather. What do you make of that? Is this a fool's errand to try to affect the price of gas at the pump through the Strategic Petroleum Reserve?
I think it's probably a good thing. I would, on balance, support it. I don't think anybody should suppose that it's going to have a huge impact. But here's what I would look at, David. The oil curve is backwardated. What that means in finance talk is that the price of oil today is considerably higher than the futures market for a year from now. What that means is that you can sell the oil and buy it back a year from now and make a profit, and at the same time help the oil market right now. So if it was a very expensive thing to do, I probably wouldn't be in favor of doing it. But at a moment when there's a significant expected profit in the deal, it seems to me like it's a good thing to do.